The blow off top has been here. If you look to a monthly chart of on the S&P 500, you will see that you have had a since 22 October, when I started to call it a blow off top. You have had it like a parabolic kind of move since then. You've had two drops there, and one of them was in I can't even make that out. But the other one was in April of 25, and then you've seen it just accelerating higher, and that is by definition the blow off top. I just want to see people say, when is the blow off top going to be here? Just look at the stock market. I mean, look at it. It's been going up, month on month on month, and then it's with the growth rates per month that are just exceeding everything we've seen previous times. So it is going up in a vertical kind of manner, and I think it's going to go even stronger higher. So I think the rotation is going on, and the blow off top, the sugar high as I call it now, because that will really be the final part of the stock market rally, because that's been going on for quite some time. That is going to be really explosive. And
Hey everyone, my name's Anthony Fatsis and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Henrik Zeberg. So Henrik is the Head Macro Economist at Swissblock. So Henrik, thanks so much for coming back on the podcast.
Great to be back.
Yeah, great. Looking forward to the conversation. But where I'd like to start is maybe looking back at 2025, because it was a pretty hectic year, pretty volatile year. So when you look back, how would you, how do you analyze it?
Well, I would say that to a certain degree, somewhat what I expected, and to some degree, not what I expected. I would say that there was the slowdown of the economy in general, which is apparently something that people are looking away from now or not really understanding. I don't know. It's not spoken so much about, and the Powell doesn't see it. Was quite clear for me. So we entered 2025 with where we had at least the leading indicators telling us that there is a situation where we should expect to see the labor market starting to deteriorate. And then we had the first few months of 25, and we saw how strong the numbers were there. And I didn't understand those numbers at all. Then we came to August, and we saw how all of a sudden things changed, and we saw this big revision in the job number, and all of a sudden the labor market wasn't this extremely strong labor market, which Powell also admitted in late 25. So this part I actually did see. I actually thought that would have brought the economy into a recession before we entered 26. I'll take that. It did not, but it doesn't mean that things are that it's not going to happen. I mean, the things are just setting up for that, and we have something we can talk about that later. But what did happen then also was that we saw this reflation of things, and it was especially when with gold and silver, and we had all of this talk about de-dollarization, and inflation was just the topic. And I again don't understand why that is so much the topic, but I kind of can see that now here in hindsight, and I think that is what the market has been wrong on. So that was interesting to see. We did see that the economy actually, pulled itself out of that abyss we were in April. You may remember also that everybody thought that we had a massive recession, or we had a recession going on. We have a massive bear market, and it turned out to be just a pullback, which I also expected there in April. So we have had this, the push and the blow off top that I spoke of. I did expect it to be actually coming to an end at this point here, but that has taken longer, and I will accept that. I'm still bullish, and I will see that I think it can go quite a lot higher actually at this point. So I think some have been as expected, and other things have not been exactly on the point, but in the same kind of environment, and in a late cycle environment, which is extremely important for me, because to me it's really about being with the risk on assets for as long as there is a sort of foundation for that in the real economy and in the business cycles, and then turning away from the risk on assets the moment that is the situation, and we're not there yet. So little of both, I would say.
Yeah, okay, really interesting. But it sounds like you think that the current trend or your expectations for 2026 have just been for 2025 have been extended. So you think they're going to sort of carry on into 2026 until everything peaks.
Yeah, because I mean, we the real economy is what drives drives everything. I know that is something that is disregarded these days in the financial world and in the markets and on X and where else, but that's the case, and I've studied that intensively. So I It's about understanding when you have the big cycle rolling over, and you are in three phases. There are four phases in the business cycle, and you have a long-term trend, and then you can be above that and rising in terms of growth. You can be above it and declining, or you can be below declining and below and rising. These are the four phases, and right now we are in that phase where we are about to cross over through the long-term trend. And that phase can take longer or shorter time. It depends on what's going on. This time, it has been clearly, we have seen this in the housing market for quite some time, that there is a deterioration. And that we have to remember back to 2005, where Michael Burry, famously he started to say, okay, there's something wrong here, and the housing market is really bad. And then it took a long time before it actually rolled over. And he was right eventually. He was right. But the thing was, it's just the leading indicator, which is the housing market. Some of the housing market is what I use in my leading indicators. Is then spilling into the labor market and spilling into the inflation and the rates, and that process can take a little longer sometimes, or shorter. This time, it's one of those where we have seen a little longer, maybe because the stimulus that we have seen coming out was so extreme after 2020 of the COVID situation there. So that's why it probably took a little longer this time. And it is what it is. I mean, for me, it's about, as I said before, being with risk assets for as long as though they are running higher, and they will do that for as long as the economy is strengthening, and until the moment where it actually crosses over. It can also be weakening, as we see now. And this is where I think I got it pretty right, and better than the Fed also, that we saw this decline in the activity in the economy. And then people will say, hey, Henrik, but you're wrong, because you look at Q3 of 25 and we had was it 4.4% growth there. What people are getting wrong is that is actually completely mirroring the situation you had back in 2007 in Q3 as well. And the 4.4% growth was quarter on quarter. If you look to the year on year, it was down to 2.3, 2.4, which actually Powell also agreed on the other day in his presser. So the growth wasn't that strong. And if you look to the numbers of it down beneath, you'll actually see that the private investments were at zero. And if you look to the consumption, which is what normally should drive it, was at 2.3 or something like this, so rather strong for consumption growth. But the problem is, it was all driven by credit card debt, and the places where the economy was growing, or the consumption was growing, was in healthcare and in insurance, which means simply that it was rising premiums and whatever is that people then finance through a larger credit card balance, which means that they simply couldn't, afford it, so to speak. So it wasn't a great number. It was terrible, actually. And you look to the consumer confidence, it's in the gutter. Housing affordability in the gutter, and we see, when you look to the non-farm payrolls now, then we actually have a situation where the 12-month moving average now on the non-farm payrolls are now below the level we have seen every time we went into a recession for the last 50 years. So anybody is talking about that this is a great economy really just needs to look to it. And if we look to inflation, and now we'll get PPI numbers here, not too a little later today. If we look to Trueflation number, this company called Trueflation, which is on X as well, and they do some quite good leading work on inflation, and they say that it seems like inflation is plummeting right now. We're down to 1.2 to 1.1% on the CPI inflation. I think that is correct, because in my leading indicators, the housing and the labor market, which is the coincident, and the lagging, which is inflation, you can actually see that there is this sequencing. So yes, to your question on this, I think this has been extended into 26. There's no coming out of a bottom here. There's no signs of bottom here at all when it comes to the business cycle. It's rolling over. And that process is just like Titanic, starting to push below sinking into the sea there. And it will take a longer or shorter time. And we start to see the lagging indicators showing us this, which means that inflation should be plummeting, and then we need the Fed to wake up to start cutting rates, which, again, I have to say, I don't know what they're looking at, but it seems like they are so far behind the curve this time.
Yeah, really interesting. And, I guess the challenge is that there's a massive K-shaped economy that we've seen the last 4 or 5 years, 6 years. So do you think that's also a risk with the data where there's just, the top 1% of people, as well as companies, are sort of investing and doing basically spending as much, but the bottom is really struggling? Or does that not really come through the data?
Something I think that's something
Yeah.
you can just check. So if you look to the situation for the consumer, it's actually the top 10% of the US population spends the 50% of the consumption in the US. We have to understand that of the US GDP, then 70% of GDP comes from consumption. And of that 70%, 50% comes from top 10% of the population. But the last top 90% of the population, they stands for the last 50%. And they are not in a good state. It's again the Titanic analogy here, where you have the third class passengers, the lowest income levels groups will simply feel the pain first. And if you look to average weeks of duration of unemployment, it's moving higher. If you look to youth unemployment, it's moving higher. So we have all the signals that this is ending up in a bad place. So I really do not understand. So this K-shape, yeah, there is 100% a K-shaped economy, but the thing is, it's always the stock market that is wrong, always. So it can go on for a little while, and I think we might even have the strongest phase ahead of us with gold and silver potentially topping out, which I think they do here very soon and may have already have. And then you're going to see that it's going to turn into risk asset, and that process can be quite explosive. And then we come to the end of that, then I think we're going to be at the end of things, because the real economy don't allow us a lot more time. However, we are not seeing the normal indications that we are, let's say, within 2 months of a recession. So it can still be a little ahead. But I would say Q2 could still be a time for a potential start of the recession without people actually really understanding that that's the situation.
Yeah, and what impact do you have on the, I guess, decreasing immigration in the US on the job numbers? Because I've heard that's a massive issue where you go from large swaths of immigration in the last 5 years to basically almost, apparently the population is decreasing in the US or expected to decrease in 2025.
Things that some of the narrative that comes up to try to explain or explain some of the things that is going on. I don't think that is some of the drivers here. I think, from a macro perspective, if you take out people that are actually producing something, that everything else being equal, it will reduce the GDP. That's the fact. There are two ways of actually making sure that you have a rise in GDP. That is either by having more people, or the person that is doing the job is becoming more productive. And when it comes to some of these jobs here, they are the labor intensive jobs, which means that you don't have robots standing there. So if that's the case, and I don't know the numbers at all, and I don't have an opinion on those, well, then you will see that the GDP, everything else being equal, should be under pressure from these things. So I don't know if that's the case, but I think it's more a narrative, a talked about thing that people want to focus on. The real situation is that we're not seeing companies laying people off in large quantities at this point, but we are seeing that people that falls into unemployment actually finds it more difficult to find a job. We can see that for the average weeks of unemployment, and also the continuing initial claims. They are still been moving up and are not looking good at this point. So but I don't know about that situation in particular.
Yeah, thanks for laying that out. But yeah, it's really interesting. And I guess another thing that people are saying is, and you could say these are headwinds, these are sort of tailwinds potentially, is energy has come down quite a lot, but also the dollar is sort of devalued as well. So would you say that's actually potentially good for the US economy?
Well, you can say that, yeah, obviously, yes, it is, and expected. Again, you don't see energy come down in price. I think nat gas had a kind of a spike also, but they also came down again. But oil has been pushing lower, had a little spike also here. But it's in general, there's been trend lower. But that's what you expect into an economy that is slowing. If the economy was really running at 5 point something percent, which I think we see the GDP now is suggesting, if you really had that kind of energy, the GDP growth, you would see the economy accelerating, and you would see energy consumption also accelerating. You don't see that, and as you don't see that, you don't see the. That's also why inflation is coming down. The dollar is a bigger thing. It's people talk now about the de-dollarization and everything. I remember in January of 25 when I was massively bearish on the dollar, and people just talking about, Henrik, we don't see any reason now why the dollar should decline, because Trump is in and it'll be all about America and it'll be all in the dollar. We can see the trend has been up, and so And we know how that went. And that's the case every time. We need people to become overly bullish or overly bearish on the dollar. And right now we're building this up. So that's all narrative on the de-dollarization, all that. It's helping, so you can trade foreign goods. If sorry that you won't go and buy as many foreign goods, but you will actually be able to sell American goods. That's good for the U.S. economy, you could say, if there are no tariffs standing in the way. But that's could also be a problem. But if you look to the latest also import and export numbers, you will actually see that import has been kind of declining, and export has been stable to a little to rising a little. So some of this is helping, you could say, on the trade balance. It's not necessarily something that is good for the economy as such, that you have this. You can run with a large trade deficit and have a fantastic economy. I know that's probably difficult for some people to understand, especially if you have a strong dollar, which you have at this point. I don't participate in the choir of people thinking that the dollar is weak at this point. It's not. So I think we have the situation where it's weaker dollars, everything else being equal, helping the economy, because then there will be more export going on, but depends on the whole geopolitical situation also. Because of what has happened, Europe is kind of pulling back a bit, and that can help or can become a problem for the US down the road if that continues. But for now, I think maybe that has been the kind of a storm that is, I don't know. Hopefully, it's over and done, and I think we will see that the normal dynamics of the economy is working out.
Yeah, and it doesn't seem to be, as you said, sort of. I think Trump and Scott Bessent came out recently saying that they still have a strong dollar strategy. I guess the recent announcement of Kevin Walsh that was just today, as the new Fed chair, assumes as well that he's not one of those outlandish suggestions who would probably cut interest rates by 1,000 basis points or something. It seems like it would be a lot more of a slower grind down, 100 basis points. Yeah. So do you have any opinions on that announcement, or what impact it will have on the Fed policy, or not yet?
Fed chair?
Yeah.
Well, I don't know. I don't know these people too much, and I haven't been diving into to the individual person so far. Everybody's focusing so much on what the Fed is doing all the time, and to me, it's if you had a situation where the Fed fund rate would have been equal to the 2-year government bond yields, you would probably have a somewhat similar situation as we have today. So I don't participate also in this hyping of the role of the Fed. They right now they are not helping the economy, as I see, and I would think that if there was I don't know if they have become political, which some people may suggest, or it's become because of their incompetence, to be quite blunt. If they look to the labor market, there is absolutely a situation where they should be much more awake than they are right now, and also if they look to inflation, which is ridiculously low compared to what we've seen into other recessions and into other slowdowns. So I would hope for the global economy that you have somebody at least coming in and being more in alignment or in tune with the economy. And I have to say, Powell has been doing a terrible job. It's not like I'm supporting Trump on this or anything like that. I have my own opinions, but it's a terrible job. Honestly, they went out and they stimulated the economy and on the demand side, extremely to an extreme degree after COVID, and you had a supply chain breaking down, and then you stimulated demand, which creates inflation. And then they got all spooked by inflation, and now they stay too high for too long on the rates. I mean, they are backward looking, so it can only be better, I would say. I'm not too impressed, honestly.
Yeah, okay, let's hope so. So you say at the moment, as you said, precious metals has had quite a massive run up. What do you think has been the main drivers of that? Is that just sort of it breaking out of its last 10-year cycle? And then you mentioned that you think it could be topping.
It has hype written all over it. First of all, when you look to gold over the very long time frame, you would see that gold actually follows the direction of inflation. And ever since 2022, we have had inflation going lower. And so why gold is peaking here is that it's not in tune with what we see in inflation. And you can go back and look for the last 50 years. It's actually for 5-10 years of a time run there, you'll see that then if inflation goes up over that time frame, you'll see gold goes with it and down and up and so on. Right now, this the last 3-4 years here now, you'll see gold just taking off and inflation just been declining. What actually has not declined has been inflation expectations. They spiked much later, and that is actually what it's all about. If you look to inflation expectations versus inflation, then there is a huge gap at this point, and that's because people have a tendency of what is called adaptive expectations, which means that what are you expecting for the numbers today is what you saw yesterday. And if that is the case, then you'll say, oh, but I've seen my groceries, they become more expensive. I expect prices to go up. And that is what has been happening over the last 2 to 3 years. People have been talking about inflation all the time. And actually what we've seen is the numbers have been declining. And they call it somewhat elevated at 2.7%. I mean, you have had long, decades long periods where the inflation rate has been around 3.5%, and the economy has been fine. So this stupidity from the Fed side to think that they need to stay hawkish at a time where inflation is at 2.7, when it was up at 5.5% in 2008, when we actually saw the economy topping out and we were in a recession at that point. And nobody can say that inflation was a problem in 2008. It was deflation. So the Fed right now is playing with fire here, and the moment that turns into that the whole hype around precious metals, where we talked about de-dollarization, which is another argument for why it's been going higher. There's no de-dollarization. If you look to the foreign exchange of reserves, then 57% of those are still in dollars, and that is very, very high. I saw a number of 40% running around on the X, which is completely wrong. So there's no de-dollarization. There's actually, I think, a lot of European states are also now buying U.S. bonds at this point. So that's all. There's often these talks, and this is based on people's adaptive expectations, which comes from on inflation, and that's why people have been talking. Oh, inflation! There's inflation, and you're seeing this famous cartoon, kind of thing where the people talk sell, and then they come. Also, when it comes to buy, and that's the narrative. That's how it goes. And right now, this has been an extreme move, and you can just see it on silver going up to 120 something dollars an ounce here. And then today, I don't know what it's down right now. It's down 15-16% earlier today, with a reversal candle on the weekly. And if that plays out by the end of tonight, I think it may bounce a little next week, but I think then the high will be in, and that weekly reversal candle of that kind of magnitude is going to send things a lot lower. So silver a lot lower. So, and if you look to the RSI level on a monthly basis, we are now at levels where we have seen 2 to 9 and 11 years periods following this declines. So these hypes here, they go berserk and then they come down quite strongly. And I also look to platinum. Platinum looks the same. I think there's a massive decline coming to that. It's all been hyped because of de-dollarization, which does not exist, and because of inflation, which does not exist. So it's simply been, it's been a hype. It's been a bubble, and that bubble will unfold, will deflate, and it will then see that money that people have now, some will get out in time and others will not, but some will actually have earned a lot of money in this, will then, start to push into to risk-on assets. So that's why I think the driver of the sugar high that I start to call it, because we have now been in a blow off top for such a long time, and now we have the spike there of the Eiffel Tower, and I think that is going to be driven by the money that will start to rotate from gold and silver into risk assets.
Yeah, okay, really interesting. And what are you saying? Do you think that would be sort of more the high beta tech assets? Are you saying Bitcoin? What other assets do you think are the more risk on where it could rotate into?
But like everything, it'll go from, so people have been in this situation where they've been risk off. They said, okay, gold and silver, we're going to have inflation. We need to be in gold and silver. And then all of a sudden people realize there's no inflation. There's no de-dollarization. And then you'll see that starts to rotate into some of the bigger names first, and there'll be the FANG stocks, and there'll be the NASDAQ. And that NASDAQ hasn't even made a new all-time high, even though the small caps and the S&P has done that. So I think you're going to see that there will be a lot of stocks there on the tech stocks and so on that will start to actually start accelerating quite a lot, and then the rotation will go on because then some of them will move a lot. And do you really want to buy Apple at this level here? Maybe. And Bitcoin has been quite suppressed, and everybody has given up on it. And then there'll start to be some buying, whether it's here or it's down at 73,000. I don't know. We could be here and also, and then you'll see that people start picking up on that, and then you'll have that hype going. So it's all about this hyping going from all bearish to all bullish all the time, and then there is the rotation in between the different asset groups. So yeah, I think it's going to be tech stocks, it's going to be small caps, it's going to be crypto, and crypto has a extreme rally in front of it, and we have to understand the difference in size of the gold market and of the silver market and of the crypto. So just if a small share of the gold market goes into to crypto, it will mean a lot for the crypto. Or if a small part of the now blown up value of silver market goes into crypto, it will mean a lot for crypto. So I think that rotation will go on as people understand that there is no inflation. We can actually be in what people call a Goldilocks again, because inflation is low and the Fed is behind it, and you have the economy is apparently strong, which I disagree with completely. And then you can have that phase developing over the next 2 to 3 months, and then you'll have the top.
Okay, and do you still, because I know previously you've talked about how you think there's going to be this blow off top. Obviously, it's probably gone on a lot longer than you expected. But then once that occurs, do you still see quite a large crash?
You have seen the blow off top has been here. It's if you look to a monthly chart on the S&P 500, you'll see that you have had since 22 October, when I started to call it a blow off top. You have had it like a parabolic kind of move since then. You've had two drops there, and one of them was in I can't even make that out. But the other one was in April of 25, and then you've seen it just accelerating higher, and that is by definition the blow off top. I just want to see people say, when is the blow off top going to be here? Just look at the stock market. I mean, look at it. It's been going up, month on month on month, and then it's with the growth rates per month that are just exceeding everything we've seen previous times. So it is going up in a vertical kind of manner, and I think it's going to go even stronger higher. Then you'll say, yeah, but that's not the same as Bitcoin and crypto. Now that's correct, and that's the part that is still missing, and people have now dismissed completely that is going to happen. And I like that. Like that people are saying that it's not going to happen to Bitcoin, because then I feel pretty certain it's going to happen to Bitcoin and to the other cryptos as well. So I think the rotation is going on, and the blow off top, the sugar high as I call it now, because that will really be the final part of the stock market rally, because that's been going on for quite some time. That is going to be really explosive, and then also rotate into crypto in a massive manner.
Yeah, okay. Super interesting. So, Henrik, thanks again for your time today. We sort of covered quite a lot. Last question is, what is one message you want people to take away from our conversation?
Study 2007 and 8. This what we see in commodities and the whole chit chat there about inflation and all that. It was exactly what we saw in 2007 and 8, and we saw oil. Put that back then, it was oil that really had a big run, and we were in a completely different state of the economy. Study the labor market. Look at the labor market. If you want to have a GDP growth, you need to have a strong labor market, and the labor market is absolutely not strong. So these are the things. And when you take all that away, then also understand that when everybody is bullish, which I've said all along, everybody will become extremely bullish at the top. Then maybe that's not the time to be bullish. But also when everybody's bearish right now with the crypto, and we don't have a rollover, as we don't completely yet, we have a weakening, but then think about maybe where the opportunities is right now, because doing a buy of $100 on the per ounce for silver is probably not the best buy you could do at this situation.
Yeah, okay. So really great points. So, Henrik, thanks again. If anyone want to find out more about your work and what you do, where would the best place for that be?
Well, on X, I'm at Henrik Zeberg, and also on Substack, also at Henrik Zeberg, and at Swissblock, reach out. It's probably best on X or at Substack, or also through our SEM services, which we have, which you can find on our website.
Great. I'll put it all in the description below, but thanks again for your time. Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.